Police officers passed this building many times without stopping, yet the significance of what was happening inside only became clear much later. In London's Docklands, glass towers rise beside older residential blocks, creating a landscape that feels both modern and settled. Canary Wharf is known for its offices, riverside walkways, and carefully planned routines. Early each morning, commuters step out of apartment buildings, coffee in hand, heading toward offices or transport links. Delivery vans arrive, lifts move quietly between floors, and security desks log visitors as part of a well-rehearsed daily rhythm. Among these buildings were privately rented flats that appeared entirely ordinary. Lights turned on in the evenings, parcels were delivered, residents came and went without attracting attention. Property managers recorded no unusual complaints. From the outside, nothing distinguished these addresses from hundreds of others across the capital. London is a city built on movement. Money, people, and information circulate constantly, often invisibly. Most of this movement is legitimate and routine. Banks process transactions, businesses transfer funds, and individuals send money abroad for family or education. These activities form the background of modern life, rarely questioned unless something interrupts the flow. Authorities later noted that some financial activity connected to these ordinary locations did not follow expected patterns. At the time, this observation did not prompt action. Records indicate that the transactions were not openly irregular. They simply did not fit neatly into established categories. Was this a matter of timing? Was it the result of informal arrangements common in international communities? Or was there another explanation? In areas with diverse populations, informal financial practices are not unusual. Many people rely on trusted intermediaries to move funds across borders quickly and affordably. These systems can exist alongside regulated services, often unnoticed. Because of this, early observations were treated cautiously. No assumptions were made, and no conclusions drawn. Life around these properties continued as normal. Security staff followed routine procedures. Neighbors exchanged brief greetings in lifts and corridors. The city moved on, unaware that some addresses were quietly appearing in administrative records more than once. Each reference, taken alone, seemed minor. Together, they would eventually raise questions. Authorities reviewing financial intelligence rely on patterns rather than incidents. Single transactions rarely tell a story. Instead, analysts look for repetition over time. In this case, records showed activity that appeared steady but understated. There were no sudden spikes, no obvious disruptions, and yet the consistency itself prompted quiet curiosity. Why did similar entries recur without clear commercial explanation? At this early stage, the focus remained broad. Analysts compared data across regions, ensuring that what they were seeing was not simply a local anomaly. London, after all, processes enormous volumes of financial activity daily. The threshold for concern is deliberately high. What mattered here was not scale alone, but context. One name would later become associated with this early review, Qi Wang. At the time, his presence in records was unremarkable. He appeared as a young adult living in London, connected to standard residential addresses. There was nothing in the initial information that suggested prominence or influence. He was one of many individuals whose details passed quietly through administrative systems. Questions, however, began to surface. Why did certain addresses link back to similar financial references? Why did activity associated with different individuals seem to follow comparable timelines? These were not accusations, only observations noted for future comparison. Still, once noticed, they could not be entirely dismissed. Soft checks were conducted using existing information. Authorities relied on open records and previously submitted documentation. No new powers were invoked. This phase was about understanding environment rather than intent. Could legitimate businesses explain the activity? Were there cultural or logistical reasons for these patterns? Each possibility was considered. As weeks turned into months, the picture remained incomplete but persistent. Analysts observed that funds appeared to move in ways that avoided conventional banking routes without breaching obvious rules. This raised another question. Were these movements a matter of convenience, or did they reflect deliberate avoidance of regulated systems? Daily life in Canary Wharf continued unchanged. Office lights stayed on late. The underground carried thousands beneath the streets. From the outside, nothing suggested that attention was slowly converging on a small number of unremarkable locations. The contrast between normal appearance and administrative curiosity became more pronounced. Authorities are trained to resist narrative thinking at this stage. Patterns can mislead as easily as they can inform. That is why early reviews often last months or even years. Patience protects against error. Eventually, a minor but notable discovery shifted the tone of the review. Records indicated that one flat, previously thought to be occupied intermittently, had been associated with repeated short-term visits by multiple individuals over an extended period. There was nothing overtly improper about this. Still, it was inconsistent with earlier assumptions about how the property was used. That inconsistency did not signal wrongdoing, but it did prompt a reassessment. Routine observation was no longer sufficient to explain what had been quietly recorded. Routine observation was no longer sufficient to explain what had been quietly recorded. Following that reassessment, authorities began to revisit earlier material with slightly adjusted expectations. The purpose was not to confirm suspicion, but to test whether the available information still aligned with benign explanations. Analysts re-examined timelines, cross-referencing property records, travel movements, and financial submissions already held within existing systems. Nothing new was collected at this stage. The emphasis remained on review rather than intervention. What emerged was a sequence of behaviors that appeared loosely connected but difficult to interpret in isolation. Individuals linked to the same addresses were active at overlapping times, yet their professional or personal circumstances did not obviously intersect. Some were students, others were self-employed. A few appeared to have no fixed occupational record in the UK. None of this was unlawful. London attracts people in transition, and such profiles are common in large cities. Still, the timelines raised questions. Authorities noted that certain individuals arrived in the UK within similar periods, changed addresses in comparable ways, and later appeared in financial references connected to the same limited group of locations. These movements were lawful and documented, but their regularity invited closer comparison. Was this coincidence or coordination? At this stage, no answer was assumed. The review widened slightly to include historical context. Financial intelligence teams examined whether similar patterns had appeared elsewhere. They found references in previous cases involving informal money transfer arrangements, often referred to in general terms as underground banking. These systems can exist for legitimate reasons, especially within migrant communities, but they can also be misused. The distinction depends heavily on intent and scale. Importantly, the activity observed here did not immediately resemble known misuse. There were no large public transactions, no sudden influxes of cash into regulated accounts. Instead, the movement seemed deliberately modest. That restraint complicated interpretation. Authorities stated later that such subtlety often delays clarity, as it sits below thresholds designed to trigger automatic alerts. Attention returned to individuals rather than figures.
Qi Wang's name appeared again during this phase, linked to more than one address under review. Records indicated he had regular contact with several others already noted in the analysis. These contacts were not secretive, they were visible through lawful records, yet the frequency suggested organization rather than chance. Other names followed, each appearing briefly, then reappearing elsewhere in the data. None were described as leaders or coordinators. Instead, authorities focused on behavior. Who visited which locations and when? How long did they stay? Did their movements align with the timing of recorded financial activity? Slowly, a pattern began to form, though its purpose remained unclear. Throughout this period, restraint guided every step. No interviews were conducted, no surveillance was authorized. The information under review had been collected through standard reporting obligations and administrative processes. This was deliberate. Acting too early risks misinterpretation, and safeguards exist to protect individuals from unnecessary scrutiny. As months passed, one aspect became harder to dismiss. The same small network of individuals appeared repeatedly in connection with different properties, none of which were registered as businesses or financial services. Authorities noted that these addresses functioned as temporary hubs rather than homes in the traditional sense. Occupancy changed, but activity remained consistent. Why would multiple unrelated individuals rely on the same locations at different times? Could these flats simply be convenient meeting places, or did they serve a specific, shared purpose? Again, no conclusions were drawn, but the questions accumulated. Financial records added another layer. Transfers associated with these individuals often appeared to bypass mainstream retail banking channels. Instead, they were resolved through intermediaries or informal arrangements. While legal in some contexts, this practice requires careful oversight to prevent abuse. The absence of registration for money service activities was noted, though at this point it remained unclear whether such registration was required. Authorities compared the scale of activity against personal circumstances. Some individuals appeared to facilitate movements of funds disproportionate to their declared income. This did not automatically indicate wrongdoing. Family remittances and community support networks can explain such discrepancies. Still, when repeated across multiple people, the pattern warranted documentation. By now, the review had expanded beyond a single department. Specialists in financial regulation, immigration compliance, and organized crime analysis shared insights within permitted boundaries. Coordination remained cautious and procedural. Each step required justification, and each observation was tested against alternative explanations. The city outside continued as before. Residents were unaware that a quiet convergence of information was taking place behind office doors. No arrests were made, no statements issued. From a public perspective, nothing had changed. Internally, however, the tone had shifted. Analysts acknowledged that the accumulation of small irregularities could no longer be explained solely by coincidence. The behavior observed did not fit neatly within typical patterns of informal finance, nor did it clearly breach existing regulations. It occupied a gray area that demanded clarity. The decisive moment came when a routine compliance check revealed that one individual connected to the network had facilitated transfers on behalf of multiple unrelated parties across different time frames without formal authorization. This single finding did not prove illegality, but it altered the assessment. At that point, authorities agreed that passive review was no longer sufficient. The situation required closer attention.
That agreement marked a subtle but important transition. What had been a contained review became a coordinated assessment, drawing in additional departments under established legal frameworks. The intention was not escalation for its own sake, but accuracy.
Authorities needed to understand whether the patterns observed were limited to a handful of individuals or whether they formed part of something broader. The first step was administrative. Records were lawfully shared between agencies responsible for financial oversight, immigration compliance, and serious crime analysis. Each body brought a different lens. Financial specialists focused on transaction pathways. Immigration teams examined travel histories and visa timelines. Analysts looked at associations, not in terms of hierarchy, but proximity and frequency. This was not about building a case, it was about building a clearer picture. As that picture developed, the geographic footprint began to widen. Addresses previously reviewed in one part of London were now compared with properties in other boroughs. Canary Wharf appeared alongside locations in North and East London, each linked by short-term occupancy and similar usage patterns. None of the properties were concealed. They were ordinary flats in busy developments, places where residents come and go without drawing attention. Why these locations, and why so many? The question resurfaced repeatedly. Authorities noted that the properties were well positioned for transport links and commercial districts. That alone meant nothing, but when combined with the movement of individuals already identified, the repetition suggested planning rather than convenience. At the same time, references emerged beyond London. Financial submissions indicated links to overseas recipients processed through informal channels rather than conventional international transfers. Again, this was not unusual in isolation. Many communities rely on trusted intermediaries to move funds quickly and affordably. What stood out here was volume over time and the number of unrelated senders whose transactions appeared to converge through the same small group of facilitators. Intelligence gathering during this phase remained non-intrusive. Authorities relied on existing reports, regulatory filings, and data already held within lawful systems. No new methods were introduced. Instead, analysts layered information, looking for consistency and contradiction. When one element failed to align, it was flagged, not assumed. Gradually, the network expanded on paper. New names appeared, often briefly, then disappeared. Some were students with part-time employment. Others were recent arrivals with limited financial history in the UK. A few acted as intermediaries, connecting senders and recipients without appearing to benefit directly. The absence of obvious profit complicated interpretation. Was this coordination or coincidence amplified by close-knit social networks? Legal advisors were consulted to ensure that each analytical step respected boundaries. The distinction between informal finance and unregistered money service activity is narrow and fact-specific. Authorities stated later that this phase required patience, as premature conclusions could undermine both fairness and effectiveness. As weeks turned into months, one development altered the tone. A routine comparison with earlier cases revealed similarities in structure, though not in scale. In those cases, informal systems had been used to move funds connected to serious offenses, often without the knowledge of lower-level participants. That comparison did not imply the same outcome here, but it highlighted risk. The scope widened again, this time internationally. Partner agencies shared high-level observations about parallel activity in other jurisdictions. No operational details were exchanged. The focus was on patterns. Small transfers aggregated into larger movements, reliance on trusted couriers, and communication through closed digital platforms. These features were noted, not explored. Within the UK, regulatory authorities examined whether any of the individuals involved were registered to provide money services. Records indicated that some were not, despite facilitating transfers for multiple parties. This raised compliance questions rather than criminal allegations. Still, it provided a clearer framework for action. The investigation also began to consider impact. Analysts assessed whether the funds moving through this network could be supporting other forms of organized activity. There was no direct evidence at this stage, but the potential consequences elevated the importance of accuracy. The aim was prevention as much as enforcement. Throughout, coordination remained deliberate. Meetings were minuted, decisions were reviewed. Oversight mechanisms ensured that expansion of scope was justified by evidence, not assumption. Then came the shift. Financial intelligence units identified a series of transactions that, when aggregated, exceeded thresholds requiring mandatory reporting. These reports did not accuse, they documented. But when placed alongside the existing analysis, they confirmed that the activity was neither isolated nor diminishing. For the first time, authorities could say with confidence that the matter extended beyond informal arrangements between acquaintances. It represented a structured system operating across multiple locations, involving numerous intermediaries and moving significant sums over time. With that confirmation, the investigation entered a new phase, one that would require formal authorization and closer scrutiny.
With that confirmation, the investigation entered a new phase, one that would require formal authorization and closer scrutiny. At this stage, responsibility shifted more clearly toward specialist law enforcement units with experience in complex financial inquiries. The change was procedural rather than dramatic. Requests were prepared, reviewed, and approved through established legal channels, ensuring that every step met statutory requirements. Authorities later stated that this phase was designed to slow the process down, not speed it up, allowing decisions to be tested before action was taken. Oversight became central. Senior officers reviewed the developing picture alongside independent legal advisors. The aim was to determine proportionality. Was the evidence sufficient to justify deeper intervention? And if so, what form should that take? These discussions were documented carefully. Nothing moved forward without clear justification, and nothing was framed as inevitable. Coordination between agencies intensified. Financial investigators, local police teams, and national units met regularly to align understanding. Each brought forward verified findings, not assumptions. When discrepancies appeared, they were logged and re-examined. In several instances, initial interpretations were revised or withdrawn entirely. This was not seen as a setback, but as evidence that safeguards were functioning. Pressure built not through urgency, but through accumulation. As more records were lawfully reviewed, timelines became clearer. Authorities could now see that certain activities followed repeated cycles, often aligning with academic terms, lease agreements, or travel schedules. These patterns did not prove intent, but they reduced uncertainty. Questions that had once been open-ended now had boundaries. Legal processes continued to shape the pace. Applications for further inquiries were submitted incrementally, each supported by evidence already obtained. This ensured that any expansion of scope was defensible and transparent. Officials involved later noted that restraint during this period prevented errors that might otherwise have compromised outcomes. At the same time, welfare considerations were discussed. Investigators were conscious that some individuals linked to the network might be vulnerable or unaware of the wider context. This influenced how information was assessed and how future steps might be taken. The focus remained on systems rather than personalities. Routine monitoring also played a role. Analysts compared ongoing financial activity against earlier baselines. In some cases, volumes decreased temporarily, suggesting caution or disruption. In others, activity continued unchanged. These observations were noted without interpretation. Cause and effect were not assumed.
One challenge was managing information flow. With multiple agencies involved, strict protocols governed who could access which materials. This reduced the risk of misunderstanding and ensured accountability. Regular audits confirmed compliance with data protection standards. As the review deepened, investigators revisited physical locations previously identified. This did not involve entry or enforcement, but contextual analysis. Lease durations, occupancy changes, and maintenance records were examined. Again, most findings were ordinary, but collectively they added texture to the broader picture. Patience defined this phase. Weeks passed without visible development. Internally, however, confidence grew that the inquiry was grounded in evidence rather than inference. Senior officers emphasized that any future action would need to withstand scrutiny not just in court, but in public review. Then came an unexpected factual revelation. During a routine reconciliation of seized administrative records from an unrelated inspection, authorities identified references that matched names already under review. The documents were not hidden, nor were they dramatic. They were compliance materials that, when cross-checked, confirmed that certain financial activities had continued despite prior regulatory warnings. This finding did not conclude the investigation, but it altered its trajectory. For the first time, there was confirmation that formal guidance had been issued and not fully followed. That distinction mattered. It shifted the focus from ambiguity toward accountability, setting the stage for the next phase.
That distinction shaped everything that followed. Once it became clear that formal guidance had been issued and not fully followed, authorities moved carefully but decisively toward resolution. The emphasis remained on process. Any action taken would need to be proportionate, lawful, and clearly supported by evidence gathered over the previous years. Formal enforcement steps were authorized through the courts. These authorizations did not presume guilt. They allowed investigators to secure materials, interview individuals, and prevent further potential harm while matters were clarified. Officials later explained that this phase was about containment and transparency rather than confrontation. Several individuals were approached for questioning under established legal safeguards. These interviews were conducted with legal representation available, and records indicate that cooperation varied. Some provided explanations consistent with earlier findings. Others declined to comment. In each case, statements were assessed alongside existing documentation, not in isolation. Where evidence met the required threshold, arrests were made. Authorities stated that these actions were coordinated to minimize disruption and ensure safety. No public displays were sought. The individuals involved were informed of their reasons and their rights, and proceedings moved forward through standard judicial channels. Court proceedings unfolded over time, reflecting the complexity of the case. Hearings focused on documentation, timelines, and regulatory obligations. Prosecutors outlined how informal systems had operated beyond permitted limits, while defense representatives highlighted personal circumstances and contested interpretations. The court's role was not to address broader social issues, but to determine responsibility under the law. Judgments were delivered in measured terms. The court found that an unregistered financial network had operated at scale, moving substantial sums without required oversight. In doing so, it exposed the financial system to risk and enabled other forms of organized activity to benefit indirectly. The emphasis was on the system's impact rather than individual character. Sentences reflected that focus. Custodial terms were imposed on those found to have played central roles, while others received penalties aligned with their level of involvement. The court noted aggravating and mitigating factors, including duration of activity, awareness of regulatory requirements, and cooperation with authorities.
No sentence was framed as symbolic. Each was tied to statutory guidance. Financial consequences were also significant. Assets identified as proceeds of unlawful activity were seized under existing legislation. Authorities later stated that while only a portion of the total sums moved could be recovered, the seizures disrupted the network's ability to operate and sent a clear message about enforcement. Throughout, officials reiterated that the case was not about targeting a community or a culture. Informal financial practices, when lawful, play an important role for many people. The issue here was scale, organization, and disregard for regulatory safeguards designed to prevent harm. Public statements following the outcomes were restrained. Law enforcement leaders emphasized accountability and deterrence, noting that complex financial crime often lacks visible victims but can have far-reaching effects. By removing the infrastructure that enabled such activity, authorities aimed to reduce those hidden impacts. For the communities connected to the case, reactions were mixed. Some expressed relief that clarity had been reached. Others reflected on how ordinary pathways can become entangled in unlawful systems without clear boundaries. Community organizations later called for better education around financial compliance, particularly for young people and recent arrivals. The resolution phase closed with formal records updated and monitoring arrangements adjusted. The network identified no longer operated in its previous form, but officials were careful not to describe the outcome as an end. Financial crime evolves and systems adapt. What mattered, they said, was that the rule of law had been applied consistently and transparently. As proceedings concluded, one observation stood out in official summaries. The case had taken years not because of hesitation, but because accuracy required time. That principle would continue to guide how similar matters were approached in the future.
That principle would continue to guide how similar matters were approached in the future. In the months and years that followed, the effects of the case became visible in quieter, less immediate ways, shaping policy discussions, community awareness, and institutional practice. Within law enforcement and regulatory bodies, the investigation prompted internal reviews. Procedures for identifying unregistered financial activity were refined, and data sharing agreements were strengthened to allow earlier recognition of emerging patterns. Authorities stated that the case demonstrated the value of patience and coordination, particularly when dealing with systems that operate in plain sight but outside formal oversight. Training programs were updated to reflect those lessons. Financial investigators received additional guidance on distinguishing cultural practices from regulated services, ensuring that future inquiries remained both effective and fair. The emphasis was on proportionality, intervening when necessary, but avoiding unnecessary intrusion when lawful alternatives existed. Communities connected to informal finance also engaged in reflection. Outreach organizations and advisory services began hosting information sessions on financial compliance, focusing on clarity rather than warning. The aim was to reduce unintentional involvement in unlawful activity by explaining registration requirements, consumer protections, and the risks associated with unregulated systems. Records indicate that these initiatives were welcomed, particularly by students and small business owners seeking certainty. Policy discussions extended beyond enforcement. Regulators examined whether existing frameworks adequately addressed the realities of globalized finance, where money can move quickly through trusted personal networks. While no single reform emerged as definitive, the case contributed to broader conversations about accessibility, inclusion, and oversight in the financial system.
There were also lasting effects on the physical spaces once associated with the investigation. Properties returned to ordinary use. Residents continued daily routines, often unaware of the significance those locations had briefly held. This return to normality was noted by authorities as a reminder that complex crime does not always announce itself through disruption. Unanswered questions remained, and officials acknowledged them openly. How much activity went undetected? How many similar networks operate at smaller scales? These questions were not framed as failures, but as realities of enforcement in an interconnected world. Complete visibility is neither possible nor desirable. The goal is balance. Importantly, the case reinforced the principle that accountability applies to systems as well as individuals. By addressing the infrastructure that enabled unlawful activity, rather than focusing solely on punishment, authorities aimed to reduce long-term harm. Success was measured not only in convictions, but in prevention. Public trust was also part of the aftermath. Transparent communication about the investigation's scope and limits helped counter misinformation. Authorities avoided broad statements and focused on verifiable outcomes. This approach, while less dramatic, was credited with maintaining confidence during and after proceedings. For those studying financial crime, the case became a reference point. Academic analyses highlighted how ordinary environments can host complex systems and how regulatory gaps can be exploited without overt concealment. These studies fed back into policy, creating a cycle of learning rather than reaction. The story did not end with closure, but with continuity. Monitoring continued, data was reviewed, new cases were assessed with the same caution that defined this one. Officials emphasized that enforcement is not a single event, but an ongoing responsibility, shaped by evidence and law. In reflecting on the case, one theme consistently emerged: the importance of looking beyond appearances. What initially seemed unremarkable required careful attention to reveal its significance. That lesson extended beyond financial crime, speaking to how institutions and communities alike understand risk, responsibility, and trust. And so, much like the beginning of this story, the conclusion returned to the ordinary. Streets remained busy, buildings stood unchanged, and daily life moved on. Yet beneath that surface, systems had been examined, assumptions challenged, and safeguards strengthened. The full truth, once hidden in plain sight, had informed a quieter, more informed future. For more calm, in-depth UK true crime documentaries focused on facts, investigation, and accountability, subscribe and turn on notifications.